So we're now going to turn to Mamadou Mbaye, who's Executive Director and Head of Energy and Mining and Capital Raising for FONSIS in Senegal. Now, it's very interesting. FONSIS, in this global debate, through its director, has had a very meaningful voice at the global level in this whole from billions to trillions. Amadou, in fact, is a member of STIP, the OECD World Economic Forum initiative, where every month they look at transactions to bring together the DFIs and the bilateral partners. USAID is a big leader in this to actually get deals financed. And their target is $100 billion of getting deals done. So it will be really interesting to hear from you, Mamadou, about the investments that FONSIS has been able to make to date, and also your national priorities of investing in national infrastructure despite an allocation of 20% to regional projects.
Okay, thank you very much, Barbara. Good morning. At FONSIS, actually, the fund was set up 3 years ago, and it has assets of a little bit over 1 billion USD. But the idea of the fund initially was really to use public funds as a leverage to attract private money into the Senegalese economy. So when we invest in a project, $1 of our money seeks to attract $10 of private investor money, be it equity or quasi-equity. And we have been successful doing that in different infrastructure projects and some projects in the services sector too. But the main idea for us and the main challenge has been on some of those infrastructure projects actually to structure the debt side of a project. The debt side is an issue because, well, our main counterpart on that field are DFIs, which are very effective in bringing the initial money. But we think that with that global economic environment where you have asset owners fighting for opportunities to invest, and the African continent seeking to finance its infrastructure development, there is on the debt side a real opportunity to structure something to bridge the gap between institutional money and actually project finance. It is true that project finance is not structured in a way that it really can welcome institutional money, traditional asset owners' money. So we have to find a way maybe to structure, this is financial engineering, but you have to find a way to structure an entity that's going to be a good investment vehicle for asset owners, and at the same time solve the debt financing problem of infrastructure on the continent. And this is actually a global question because if it's sorted out in Africa, it will be sorted out elsewhere. And in those infrastructure projects, there is something very key. You have the construction phase, which is the risky phase, actually, the risky one. And you have the operational phase, which is a little bit different because when you get to operations, actually, you have a business, you have contracts in place, you have revenues, actually the facilities are finalized, they can be put as a guarantee. So we are in another risk environment where maybe pension funds and sovereign funds with fiduciary requirements would be able to actually get in. On the construction phase, on the other hand, you may have a more risky lending environment where maybe banks would be more effective to get into play. So if we can think about two types of debt financing structures, one for construction, seeking to actually link to banks and maybe DFIs, and one for the operational phase, which is going to speak more to long-term investors, because construction is 5 to 6 years, operation is 20 to 30 years. Long-term investors, be it the debt side of institutional investors, that can be insurance, but it's global asset owners, can be pension funds, it can be sovereign funds. There maybe we could find a solution to one of these issues we think about, not speaking about guarantees. So I want to stop there, but those are a few ideas I wanted to drop on the discussion.
Well, thank you. And you were alluding to a specific structure that I'll just quickly put on the table, which we actually started to discuss with the pension funds in Uganda and Tanzania, and then the DFI that was supporting us, their program just ended. Anyhow, financial engineering, very simple. You could design a contingent refinancing facility for pension funds to increase the de facto tenor to whatever you need, 20 years or whatever. So the front part of the financing is the banks provide the funding for the construction risk, which is the risk that they're able, and very important to impose that market discipline. And then there's a takeout facility that the pension fund or the sovereign wealth fund says that at the end of construction, provided there's cash flow and it's performing operational per the fiduciary due diligence requirements of that pension fund or sovereign wealth fund, they are prepared to fully fund it. You know, what will happen de facto is most banks will say, great, it's a performing asset, we're just going to have an evergreen asset and keep turning it over. Pension fund makes money on its fees, it's got reduced risk, and then we can scale. But these are the kinds of financial instruments we need to just create, pilot, and scale. Because we know, especially with Basel III, banks are going to be pushed more and more to the short term. They're already short term enough. So we need these financing solutions.
Doing business in Africa. You can't afford to be without Africa Investor.